Kunle, good morning.
Good morning, sir.
Mr. Wellington, good morning, sir. Kwa, good morning. D, good morning. And who else? Epo, good morning. I think I've greeted everybody. Okay, we can start the class. We are running behind the schedule. How was your weekend? Week, rather. Hope you had a blessed week. Okay, in our last class, we're looking at basis of assessments, where we talked about basis period. We looked at it extensively. Today, we're going to continue from where we stopped. If you have any question, do not hesitate to interject at that point in time and ask your question. Okay? It is very important that everybody in this class is carried along. So okay, I'm going to share my screen now so that we can continue from where we stop. So the schedule for this week is that we should round off with basis period. So I'm going to squeeze in the basis period to this week so that by next week we can go straight to loss relief and adjusted profit. By upper week, we're starting total profits so that we can quickly, because this diet is very short, so we're going to systematically move the class on a steady pace. So if you have any question, do not hesitate to ask me, and I'll be willing to answer you appropriately. Okay. In our last class, we were talking about basis period, and today I said we are going to look at the computation of our accessible profit. Now, you remember in my last class with you, one of the things I told you was that when a company commences operation, 3 years are statutory, and these first 3 years shall be assessed to tax as follows. I said the first tax year will be assessed to tax from the date of commencement to the end of the accounting year end. That is, if a company commences operation 1/5/2005, 2022, for example, and let us also assume that the company has an accounting date of 30th September annually. So we can say the first accounting year of the company will be 1/5/2022 to 30th September 2022. That will be the first accounting year of the company. That will do the first tax year rather, and that will be the first basis period. So I am saying directly that when a company commences operation is going to be from the date of commencement to the end of the company's accounting year end. Having said that, we move to the next one. You have this material I've shared with you before. We move to the next one, which is the second tax year. The second tax year shall be assessed to tax from the date of commencement, from a day immediately after the end of the first accounting year end to the end of the second accounting year end. What we are trying to say here is that you remember we said the first accounting, the date of commencement of this company is coming. Is one, oh, this is too thick. We said 1/5/2022. And I also told you that let us assume that this company prepares account to 30th September annually, accounting year end, 30th 9 annually. So we now said for this company that has commenced operation on these dates, the first tax year will be assessed to tax from the date of commencement to the end of the first accounting year, and the accounting year end of this company is 30/9 annually. Do you understand that? So we now said the second tax year. So this first tax year, because under Finance Act only recognizes preceding year basis. Therefore, this company will be assessed to tax in 2023 in their first tax year. In the second tax year, which is 2024, we said the company will be assessed to tax a day immediately after the end of the first accounting year end. What is a day immediately after this date? It should be 1/10/2022 to the end of the second accounting year end, which is 30/9/2023. The third one will be 1/10/2023. That is, the third tax year will be a day immediately after the end of the second accounting year end to the end of the third accounting year end. So 30/9/2024. And the tax year for this guy will be 2025. Why 2025? We have said it before. It is because of the preceding year basis rule. So that is that. Any question? Okay, sir, the commencement date is for no. So what I'm just citing an example. Do you understand? I'm just citing an example. Please, someone should help us to share the material that I've shared before on our group so that we can be on the same page. Thank you, Abiola. So I was making an analogy that let us assume that the company commenced on 1/5/2022. Okay. So I'm trying to re-explain and re-emphasize what we had discussed last week. So today, let's go straight to the question and let's see how to assess a company that is just commencing operation. We said Nengi Nigeria Limited was incorporated on 1st of April 2019, but due to logistic issues, the company did not commence operation until 1st of April 2020. The company's accounting year end is 30th September annually, and the following information relates to the company's income statement. Now, when you look at what we have here, you would realize that the Nengi Associates or Nigeria was incorporated on 1st of August 2019. Now, being incorporated on 1st of August 2019 does not mean the company has started operation. So we have to look for the date of commencement. And the date of commencement in this regard is actually 1/4/2020. Okay. So going by the principle I explained earlier, I said if a company commenced operation, the company is going to be assessed with tax from the date of commencement to the end of the accounting year end. Now, don't forget, the accounting year end of this company is 30th September annually. It's 30th September annually. So, and the date of commencement is 1st of April. Those are the 2 dates we need. We do not need the date of incorporation. Therefore, if that is the case, I would start by applying my principle and ensure that all these profits that we have there are captured. Now, in doing that, the profits that the examiner gave us ended in 2024. And you remember, I've told you earlier that companies are assessed to tax on preceding year basis. If companies are assessed to tax on preceding year basis, it will mean that the profits of 2024 will be assessed to tax in 2025. You remember my last class with you, I said a preceding year basis is a base period that must have started and ended before the tax year. Is a basis period that must have started and ended before the tax year, taking cognizance of the company's accounting year-end. Taking cognizance of the company accounting year-end. So that is what exactly happened here. So the accounting year-end is this, the 30th September. So what we're trying to say here is that the profit of this 2024 will be assessed to tax in 2025. Having said so, we move on to what is the first tax year. The first tax year for this company, just like I've said, is we have to identify the basis period first. My basis period will run from, excuse me, let us identify the basis period. This company commenced 1/4. So it's going to be 1/4/2020. What is the accounting year of this company? September 30 annually to September 30. 2020. So who can help me out with the relevant tax year in this situation? Knowing fully well that our company usually operates on preceding year basis. Who is helping us out? What is the relevant tax year for this?
2021.
Thank you. 2021. Thank you, everybody. It's 2021 based on the principle that we have discussed. It's 2021. So I will now say my relevant year, I will have Nengi Nigeria Limited computation of assessable profit for 2021 to 2025. How did I get my 2025? The 2025 I got is as a result of this last profit, which was 2024, and it should be assessed tax on preceding year basis. That is how you write your assessment year. Do you understand? Do you understand? Okay, I want to assume that we understand that. So I delete all this. So the next one that we're going to be looking at is how do we ascertain our profit? It is very important. Now, before that, you would have to write your basis period. The first tax year will be from 1st of April 2020 to 30th September 2020, which will be the first tax year, which is 2021. In 2022, you remember, we said our second tax year will be assessed to tax from a day immediately after the end of the first accounting year. What is the date immediately after this one? Which is 1/10/2020 to 30th September 2021. And of course, this will be assessed to tax in 2022. In 2023, the Act says a day immediately after the end of the second accounting year end, that is a day after this, which is 1/10/2021, to the end of the third accounting year end, which is 30th/9/2022. And for fourth and subsequent years, it is going to be on preceding year basis. Having said that, we will now move. Wherever you see period to in my last class, I remember I told you period to means a period that is either more than or less than 12 months. That is either more than or less than 12 months. So if that is the case, what do? We say, let's identify what this means when we are doing our basis period. What does this mean? This period in this situation means from when this company commenced operation. The company commenced 1/4/2020. To these dates, how many months is that? Someone should help us. Who is helping us? How many months is this? I am waiting. Say it, don't type. Say it.
6 months.
6 months. Okay. Ibukumi, you are not seeing the question clearly. Who is also saying it? It's not 6 months, it's more than 6 months.
16 months.
16 months. Kelvin, you don't know how to calculate dates.
16 months.
16 months.
18.
18 months. 18 months is the correct month. Let's go. From 1/4/2020 to 31st/12/2020. How many months is this?
Six.
Faith is not correct. Look at what I've written down. From 1/4/2020 to 31st/12/2020.
9 months. 9 months.
9 months. Mary, Mercy, you are welcome to class. 9 months. We caught you red-handed. 9 months, right? Now, that is not the end. You remember, we are still going to what? 30th September 2021. That means from 1/1/2021 to 30th September 2021. How many months is that? We know that one. Very straightforward. How many months? 9 plus 9. How many months is that? 9 plus 9 is how many months?
18.
18 months. Good. So that means the entire number of months we have here is 18 months. Okay? Is 18 months. This 18 months, the profit for the entire 18 months is 25 million. Is 25 what? Million. Now, how many months? We go back to our table. You remember, we have said this first month is 18 months, have you? But according to our principle, we said when a company commences operation in the first tax year, such a company will be assessed to tax from the date of commencement, to the end of the first accounting year end. Now, when you look at this, from the date of commencement to the end of the first accounting year end, how many months is this?
That's 6 months.
Good. That's 6 months, right? That's 6 months. Now, the 6 months, where can we see the 6 months? We go back to this first one. You remember, I told you specifically that this period had started from the date of commencement, right? If this period has started from the date of commencement, that means this guy that we have here will fall within this period. One for 2020 to 30th 9 2020 is within this our first period, isn't it? Isn't it? Is within this our first period because this our first period started from 1 for 2020 and ended 30th 9 2021. That means 1 for 2020 to 30th 9 2029 is within this period. Abi? Meanwhile, we had agreed the other time that the number of months here is 6 months. But the number of months in this entire period is 18 months. Out of the 18, I need 6. So I will say 6 over 18 multiplied by 25 million. Whatever we have is the answer. So what we had there is this value. Do you understand me? Do you understand what I mean?
Yes, sir.
Good. Who is not getting me? Please, this is very critical for the future class. Are you getting what I'm explaining? Please, I'm asking again. It's critical for our future class. So in case you are not getting me, please ask question. Okay? So we move on to the next one. I want to believe everybody understands that. The next one will be 2022. And in our 2022, you remember we said it's going to be from the date of commencement. Sorry, a day immediately after the end of the first accounting year end. So a day immediately after this guy is 1/10/2020 to 30th 9 2021. Right? So if that is the case, what are we saying? This 1/10/2020 to 30th 9 2021 is also within this first period, isn't it? Let's go again. If you're in doubt, we said this must have started from the date of commencement to 30/9 2021. But now, according to our principle, in my second tax year, I need 1/10 2021 2020 rather to 30/9 2021. Where can I see that? When you come back to the basis, the question the examiner gave, you will notice that it's still within this period. But don't forget, the entire number of months in this period is 18 months. But this period that we need here is 12 months. So what I will just do is to say 12 over 18 multiplied by 25 million. What I will get is 16 million 60,066,667. So that is that. Now, one thing I want you to realize, for those of you that you have done tax in the old syllabus, then we usually say when a company commences operation, the company will be assessed with tax from the date of commencement to the end of the year. We now also say again that the company in the second tax year will be assessed with tax from the date of commencement again to the first 12 months. The third one will be on preceding year basis. Now, in the old tax law permits overlapping of basis period. This new tax law has eliminated any form of overlapping of basis period. Let me explain. So in the old tax law, if a company commenced operation this same date that this guy commenced, the first tax year will be from date of commencement to 31st 12 of same year. In the second tax year, it will also be from the date of commencement to first 12 months. In the third tax year, it's going to be on preceding year basis. We have our accounting year end. In the old tax law also, when a company commences operation, the company will be assessed the tax in that year. Now, when you look at what we're having here, you will notice that the basis period you have in the first tax year, you have same in the second tax year, you have some of it in the third tax year. So that gives room for overlapping of basis period. Okay? But when you look at what is happening now in the new tax law, the year of assessment is on preceding year basis. That's number one. Number two is that there is no overlapping of basis period. As this guy ended, this guy commenced. As this one ended, this one commenced. As this one ended, this one commenced. Look at this guy. As this one ended, this one did not commence. There is overlapping of basis period. As this guy ended, this one did not commence. There is overlapping of basis period. And even, yes, there is overlapping of basis period. So that was one of the reasons why this old tax law was cancelled and replaced with the new tax law. Now, I'm cleaning that out. We have the video of the class. You will get the video at the end of the day if you need clarification. Now, in the third tax year, don't forget, we are still on this profit. In this our third tax year, these profits that we have here must have started from 110 2021 and ended this date. This other one must have started from 110 2022 and ended this date. This must have also started from 110 2023 and ended this date. Now, let's begin to look at our basis period that we have written in our question. In our basis period that we have written in our question, you will notice that in 2023, my basis period is 110 2021 to 30/9 2022. When you look at the question examiner gave us, you notice that it is the same thing. It coincides directly. Since it coincides directly, what I will do is to take the value. Do you understand me? So I'll take the value. There is no calculation involved because it's the same number of months that I need that is requested. I'll just pick the number, the profit that is attributable to that month. And the attributable profit to that month is 15 million. The same thing for 2024. Look at the basis period here. Excuse me. Look at the basis period here. 1/10/2022 to 30th September 2023. Look at what we have here. 1/10/2022 to 30th September. You will notice that it's the same. So no calculation is also required. So I'll pick my figure. I pick. The next one is the last year. In the last year, you would have 1/10/2023 to 30th September 2024. When you look at the profits that we have, it's the same thing. The base what we have for our computation. We have 1/10/2023 to 30/9/2024. It's the same thing. I'll pick my figure. No calculation is required. So I'll pick it. So that is it. And that is the end of commencement rule. Do you have any question for me? Do you have any question? If there is no question, we can move on to the next one. Who just joined the class? Mr. Oseni.
Yes, sir. Good morning, sir.
Nakwana.
Lafia.
Welcome. All
Sorry, I just joined late. That's why I don't want to talk to you.
Yeah, I know. Welcome.
Thank you. Thank you, sir.
Yeah. So we can move on to the next one since every one of us understand this. So the competition is there. You can also look at the next question and use that as a practice question. At the end of today's class, I'm going to be sending you question on basis period that you're going to practice, and you send me your answer. Anyone that you've done, you send the answer to me at the end of today. I'll send it to you. I'll share with your class. Okay. The next one is cessation. The reason why I'm taking my time to teach this topic is that when we get to pioneer legislation, under pioneer legislation, we are still going to be making use of basis period. If you do not know it, it's a problem. That's one. When we get to capital allowance, basis period is very important. If you do not understand it, there is a problem. When we get to loss relief, basis period is very important. When you do not understand it, there is a problem. Okay? When we get to company's income tax proper, if you do not understand basis period, there will be a problem. And don't be surprised, examiner had asked questions in the past on basis period. They have. So the examiner can still ask questions on basis period. There is no part of the exam, of the syllabus the examiner cannot test. So don't commonize this topic, okay? Because it's a very important topic to you. Let's go. Now, the next one that we're going to be talking about is cessation of business. So when a company ceases operation, in taxation, what we are looking at is a permanent stoppage to production process. Permanent what? Stoppage to production process. So we are not looking at any temporary stoppage. Because temporary stoppage would mean that the company is on strike, or maybe they are renovating the office, they are now saying, okay, let's stop for a while, we'll come back. Or maybe during the COVID period where a lot of people had to stop work to take care of themselves, and after the COVID period, they resume back to work. We do not call that a permanent stoppage of business, because the company will still come back and continue to operate. When you say a company has ceased operation permanently, what we're trying to say here is that the company is no longer in existence. They want to stop operating. And in the case of Diamond Bank and Access Bank, Diamond Bank was acquired by Access Bank. According to tax principle, a company that has been acquired will be forced to cease operation. The company will be what? Forced to cease operation. Why? The company that is acquiring the other company will be on a going concern. Except if, for example, the two companies are starting all over. If that is a combination, company A and company B comes together, that's what we call business combination. Now, under the business combination scenario, company A and company B that come together, the two of them would be assumed to have ceased operation, and the new company that is going to be formed will be starting on commencement rule. Okay, that is that. But for example, in this our own scenario, when a company ceases operation, that means the company is no longer in operation, is no longer in existence. Now, there could be many reasons why company might decide or might choose to cease operation. One of the reasons why company might choose to cease operation is government could be legislating that. Government could say, okay, cease operation because of the kind of business you are doing. I'll give you an instance. During Obasanjo regime, if you have been importing frozen fruit to the country, and that is a major thing that you do, I remember Obasanjo put stoppage to that because we want to boost the local market. We want to boost our local market so that they will be able to compete favorably. So the government of the day then put stoppage to that importation. Imagine that is the major source of income of the company, or imagine that is the major thing the company does. That means this company would have to cease operation permanently, because there is no other thing that the company will do. Or if the company is involved in illegal business and government of the day eventually gets to know of the business, a lot of big people are doing businesses that it is illegal, so to speak. But they use tie to cover it up with other businesses, okay? So by the time the government finds out that business, that means the company would have to die automatically. So, and we don't also expect, as a good citizen of the country, to be carrying out illegal activity. That is not the kind of money government is looking for. Government is looking for money, clean money, okay? So when that kind of a legislation comes, even if it was legal before, that importation of turkey was legal, it has now become illegal. So you cannot do that kind of business again. Again, which is very important. Source of raw material is very important. Imagine a company is an oil company, and their own source is from crude oil. Okay, And let's now assume the hole in which they are extracting the oil dries up. What will happen to the company? The company will not have any other opportunity to continue running because their source that is generating revenue to them has been put on hold because they've lost that part that is generating revenue to them. Then, if that is the case, the company would have to shut down. Natural disaster is another thing. Earthquake, flood, fire disaster can run a business aground. What about inability to compete in the market? What is happening today to many companies in Nigeria is that they do not have the ability to compete in the market. And because of this lack of ability to compete in the market, a lot of them begin to leave the country. Okay? So we could say that, they have stiff competition or economic prices does not favor them. They will look for alternative. Or some of them will even stop coming to your country, or they will stop business operation and shut down. When you look at statistics as of today, a lot of manufacturing company in Nigeria are shut down. Pharmaceutical company in Nigeria has left. A lot of them begin to leave the country because the economic indices does not favor them. So they could not also compete favorably with their counterparts maybe in the other country. Therefore, the companies began to leave the country. So when they leave too, that means we have to shut down their production process. That is also an example of permanent stoppage. A creditor can stop you from operating. They can shut down your business. If you owe them and you are not able to pay, if you are not able to settle your liability, the creditors can shut down your business. Courts can shut down your business. There can be a court order that this business will shut down. So there are various ways in which company can be shut down. For you that have done business law, you would understand what I'm saying clearly. That in business law, a lot of this kind of thing has been discussed when you were discussing the solution of company under business law. And before you guys got to this company, to this class, you would have done business law, right? So that is that. So we move on to what is the tax implication when company decide to cease operation. Our focus is on company, not individual. Okay, when a company decide to cease operation, the company shall be assessed with tax from the beginning of the accounting period to the end of the business life. So, if, for example, the company is supposed to end its operation in a particular period, you remember in our accounting, we said company must operate into perpetuity, right? Without having an ambition of liquidating. So let's assume this company has been operating for so many years. Has been operating for so many years. So that means if the company has been operating for so many years, they would have had a constant accounting year end. Abi, I am now saying, let us assume that this company ceases operation. When company is ceasing operation, you will see period to at the end of the question. Not, when the company is commencing operation, it is at the beginning you will see it, but if they are ceasing, you will see it at the end. So let's now say period to 31st/12/2026. So we said when a company ceases operation, the company will be assessed with tax from the beginning of the accounting period to the end of the business life. So all these ones would have been applying our commencement rule. Sorry, our going concern rule. That is, when a company during the fourth and subsequent years, they are assessed with tax on preceding year basis. So this guy would have been assessed with tax in 2024, and my base rate would have been 110, 2022 to 30th 9, 2023. Okay. Next one will be 110, 2023 to 30th 9, 2024. Who is telling me what is the relevant tax year for this guy? What's the relevant tax? 2024.
Oh.
Thank you, Ibuku. 2024 is relevant tax year. The next one will be 2025, right? Now, the next one will be 2026. That is from 110, 2024 to 30th, 2025. 30th, 9, 25. Again, do not forget that after this date, we now have period to this period to means from 110, 2025 to 31st 12, 2026. Now, what we're trying to say here is that you have to still take another period from here, which is 110, 2025 to 30th 9, 2026. Now, the principle now says when the company ceases operation, the company will be assessed with tax from the beginning of the accounting period. Now, the year of cessation has this beginning of the accounting period 110 in this our scenario, 2026 to 31st 12, 2026. Now, this will still be assessed with tax in 2027. But what I am trying to make you understand here is the last tax year. In the last tax year, the company will be assessed with tax from the beginning of the accounting period to the end of the business life. This business will terminate when? 31st 12, 2026. So beginning of the accounting period will be what? 110, 2026 to 31st 12, 2026. Now, according to the tax law, when a company ceases operation, the company shall be assessed with tax within 6 months after the year of cessation. The company shall be assessed with tax within what? 6 months after the year of cessation. Therefore, the relevant tax year for this last period will be 2027. That is within 6 months. So if you count 6 months, within 6 months, that within 6 months after the year end will be 30th 6, 2027. So that means this guy must pay its liability, file returns within 6 months after the end of the cessation. Do you have any question? Do you understand what I am saying?
Yes, please. Sorry, I have a question.
KP, you are welcome. Just join the class.
Yes. So the one without cessation, are you counting 3 months, or you're just the fact that the year it ends cannot be the year that you assess as the tax year? You now use the next year. I'm just looking at the what this thing you're using to determine the tax year.
Oh, okay. No. So that principle is different here. In this place, we look at in the year the company ceased, they must pay their final tax liability and file returns within 6 months. Meanwhile, for a company that has been existing before now, such a company will be assessed with tax on preceding year basis. Okay? It is going to be assessed with tax on preceding year basis. And that's what we are trying to say. And for my preceding year basis, it means a basis that must have started and ended before the tax year. And that is why all these other ones, you will notice that the basis period ended before the tax year. Okay? So that is that. All right. I'm clearing all this. So we'll move on to how do we assess the company to tax computation. I have explained what I've just explained here. I've explained it here. Look at this guy. Bank PHB. Nigeria makes up its account on 31st December and permanently ceased operation on 30th April 2020. What will be the relevant year and when this company will pay tax? Now, in 2020, the accounting year of this company is 31st December annually. So I'll still have 1/1/2019 to 31st 2019. You must file your returns within 6 months. But that will not be our case here because this company year of assessment is 2020 because it's going to be on preceding year basis. However, we also said that when a company ceases operation, the company will be assessed with tax from the beginning of the accounting period to the end of the business life. The beginning of the accounting period in this current year is 1/1/2020 to 30th for 2020. And the company must file its assessments within 6 months. That is from now till October. The company must submit assessment. So this is still within 2020. So the year of assessment, that is the tax year, is 2020. Let's look at this guy. This other one. TOG Limited makes up its account on 31st December annually and permanently ceases operation on 31st July 2020. If you want to go by the same principle, 1/1/2019 to 31st July 2019 will be the first assessment in that year. But we're now saying that this company wants to cease in July. That will be from 1/1/2020 to 31st July 2020. The company must file returns and pay tax liability within 6 months. So within 6 months, this has fallen into 2021, unlike the other one that is still within 2020. Within 6 months of this guy, is still within, is 2020. Look at this guy. Within 6 months is actually 2021. Do you understand? So, and the relevant year for that will be 2021. KP, are you Diamond? KP. KP.
Is it
KP.
me?
Yes. What is your name?
No, Kachi.
Okay. All right. All right, let's go. So do you have any question with regards to how to determine the year of assessment for a company that is ceasing operation?
No.
Okay, what about any other person? Okay, if that is the case, I'm giving you illustration 3, everybody. Look at this illustration 3 and tell me the relevant basis period that we are going to bring out from there. And at the same time, you tell me the tax year for the 2 basis period. I am waiting.
Mm, 2021, or should we type it?
No, go ahead and say it.
Okay, for the preceding year basis 2021, then the cessation 2020.
Okay. Is that correct? Let's go. The first thing I will do is, who else is trying? Who? So I will have 1, then 2018 to 30th 9 2019. Beginning of the accounting year end for the next one will be 1/10 rather 2019 to the end of business life 30/6/2020. This is 2020 and this is also 2020. Do you understand what I'm doing at all?
Yes. I used I didn't see it. I didn't see 30th of June. Sorry. So I used 1/10 2019 instead of 2018
Okay,
for the preceding.
good. So now that everybody understands that, we can now move on to illustration. We can now move on to illustration. But before we move on to illustration, now you understand how to identify year of assessments. The next one we need to talk about is post-cessation income and expenses. When a company ceases operation and the company had incurred some expenses, or the company had generated income, the income generated will be deemed to have been generated on the day the company ceases operation. You know, the company has generated this income after cessation, right? We are now saying that the income that you have generated will be assumed that you have generated it on the day you cease, not even after. Again, what about expenses incurred? Expenses incurred will be assumed to have been incurred a day on the day of cessation, even though you have incurred it after cessation. And on the variance of the two, you calculate your tax liability. I'll say it again. This is what I'm saying. According to the Act says that any income or expenses incurred after the date of cessation will be deemed to have been received or incurred respectively on the date of cessation. And therefore, the company in effect now must make sure they adjust for the profits or for the income and expenditure on their terminal profits. So in that regard, we could have several expenses that will be coming after the company has ceased operation. We could have terminal expenses such as winding up expenses, liquidation expenses, costs you incur in recovering your debts from the debtors, and so on and so forth. You could also have, recover some income that you thought had been lost from your debtor, bad debt recovered, and some other things could be recovered even after the cessation of business. And the Act does not put date restriction to this. So that means if a company is operation and they make income after 5 years, they recover their income after 5 years, the tax authority can tax it. Okay? That's what we are saying. If they incur expenses, I don't know whether there is tax credit for that, but I don't think so. So that is that. Let's go to our illustration. And after that, we'll move on to the next topic. Someone is helping us read this illustration. Illustration number 4. Who is helping us?
Let me read. Golden Touch Limited, a company located in Kafancha, Lugbai State of Nigeria, commenced operations on the 1st of November 2020. The accounting year end was 30th September. As a result of the stiff government policy on the importation of rice, which the country deals with, the going concern of the company becomes threatened, and the board of directors decided to cease operation on 31st December 2024. The adjusted profits for the years of cessation data as follows. All figures assumed to be correct. You are provided with the following additional information. First one, bad debts in the sum of 120,000, which was written off in 2022 assessment here, was recovered in October 2025. A sum of 20,000 was spent to recover the debts. An expenditure of 350,000 incurred as a liquidation expenses was not paid until August 2025. On cessation, the Revenue Authority intends to conduct a back duty investigation, and the taxpayer has been duly informed. As a tax consultant, you have been invited to ascertain the assessable profits for the periods covered by the commencement of trade and cessation of business.
When an examiner says, as a tax consultant, you know the difference between students that will pass exam and students that will not pass. Once the examiner begins to talk in this manner, examiner wants a report. Examiner wants a report, and you must respond back to the examiner in report form, even though the question is very straightforward and simple. That's number one. Number two, before you attempt this question, you must identify that two questions are meshed in one. Number one, this guy is just commencing operation. Commencement of trade is in this question. Number two, this guy is also cessation of business. Okay? So if that is the case, let's move on. When a company commences operation, what did we say would happen? We said the company will be deemed to have commenced the business by being assessed the tax from the date of commencement to the end of the business, to the end of the first accounting year end. Now, what is the first accounting year end of this company? Who can tell me the base period? Oh yeah, who is telling us the base period? What would happen in this scenario? So should help us out.
The basis period is 1st November 2020.
Hold on, don't rush, Tisha. 1st November. This one is deleting. 1st November
2020
2020
to
to
30th September.
when?
2021.
Kelvin, this will be assessed the tax when?
Tax year will be 2022.
The second tax year will be what, Kelvin?
The second tax year will be 1st October 2021 to
So
30th September 2022,
assessment year.
2023.
The third one.
1st October 2022 to 30th September 2023,
Assessment year.
2024.
Next.
1st October 2023 to 30th September 2024,
Assessment year.
2025.
The last one.
The last one, it will be 1st, but the okay, 1st October 2024
to the end of
to
business.
31st, yes, that's 31st December 2024.
Assessment year.
2025.
We have been able to write our basis period on this. So on the top of our question, we are now going to say computation of accessible profit for 2022 to 2025 year of assessments. Mr. Wellington, I've not heard your voice since morning. Hope you are good.
Yes, sir. I'm following you, sir.
Are you following?
Yes, sir. Yes, sir.
Good. So, if that is the case, we have gotten our basis period, right? So the next thing that we need to do before we go and do anything, these adjustments must be done first on our terminal profits. The adjustment will be done on our terminal profits. So let's go. If that is the case, our terminal profit is this profit, this last one. So anywhere you see period 2, that is where the terminal profit will be. So this terminal profit will be adjusted. So in adjusting that, bad debt recovered. Is it an income or an expenses?
Income.
What do we do to income?
We add.
Add it back.
We add. Good. bad debts, amounts used in recovering the debt, 20,000. What do we do?
We deduct it.
Good. Expenditure of 350K incurred as liquidation expenses was not paid until 2025. What do we do?
To be deducted.
Will be deducted. So that means I am adding 370. So I'm adding 120 and I'm deducting 370 from this guy. Abi? So
Yes, sir.
let's go and see the solution. So that's what we have done here to get our terminal profits. It is this terminal profits you would adjust. Now, you remember that when we wrote our base period the other time, we said from 1/11/2020 to 30th/9/2021. Abi, which is the same thing we've written here. That value, that base period coincides directly with this. So I pick the value. No calculation is required. The same thing for this one, no calculation is required. The same for this guy, no calculation is required. But the last one, calculation is required. The entire profit we have here is from this guy is from 1/10/2023 to 2024. How many months is this? Who is telling us? How many months?
Fifteen months.
15 months. Good. Out of that 15 months, I'll need 12 months. 12 for the first one. That is from 1/10/2023 to 30th/9/2024. And I'll now multiply the value with this. That is 12/15 multiplied by 6050. Whatever we get, which is this, we get this. The next one is 3/15 multiplied by that value. You get your answer. So you get 1.2. So that's how those numbers were gotten. Do you understand? Any question? Any question?
Wherever so.
Alaji, you have question? Mr. Hussein, mute your phone. So that is that. Do you have any question? Okay. In the absence of no question, we'll move on to the next one. So we are done with cessation of business. The next one that we're going to be talking about is change of accounting dates. Change of accounting dates. Now, examiner in the recent time have tested change of accounting dates. And they wanted you to make decision from it. In fact, let me look for the first question. Which is going to be most likely your assignments. After we have done with this. So examiner usually asks question on basis period. So don't think it is only for skills level. No. This class should be asked. No worries, I will look for it and ensure I send to the class. I'll send you the year to go and look at it. In that year, they wanted students to make decision. They wanted students to make decision. Okay. While I still look at that, let's go ahead. When you talk about change of accounting dates, what exactly are we talking about? Now, company will change the accounting dates when the known dates that they have been known to be preparing the accounts, and all of a sudden, the company can decide to adopt another accounting date. Imagine a company that will be preparing its account on 31st December annually. And all of a sudden, the company now decide to change to 31st March annually. You can see that there is going to be gap in basis period. Okay. To correct that, because the taxpayer at every point in time is looking for a situation where he's going to pay a reduced tax revenue, tax. Meanwhile, the tax authority is also looking for a situation whereby they will charge more. Okay. So we are now saying a taxpayer had looked at all his tax planning and say, okay, it should be better for me to change my accounting data. The tax authority say, okay, if you want to change your accounting data, there is no problem. I am going to assess you based on the one that will result into maximization of revenue to me as a tax authority. And that is that. So we are saying that company might decide to change the accounting dates from the known date to another date. Imagine a company has been paying the accounts to, just like I said the other time, to 31st December. To 31st December. So as the company has been paying the account to year end, 31st December 01, year end, 31st December 02, and all of a sudden, the company decided to change the account to 31st March 03. Year ended 31st March. 04. Call this one scenario 1. Scenario 2. Assume a company has been paying account to end, year end, 30th 4/01, year ended, 30th 4/02, period 2. Thirtieth 6/03, year ended, 30th 6/04. If you look at first scenario and second scenario, what would you say has happened? First and second scenario, excuse me, guys. So look at the first scenario and second scenario and tell me what you can notice, what you notice. So when was the year of change in this in the first scenario and second scenario was the year of change?
In the first scenario, sir, the year of change is 2003. Because in that 2003, the year end, which used to be December, did not end in December 2003. And in the second scenario, the year end that used to be April did not end in 2003.
Mr. Wellington, say that again.
I said in the first scenario, sir, we observe that the year has been ending in December.
Yes.
In the year 2003, the year did not end in December. They said the year did not end in December in 2003 in the first scenario. And in the second scenario, the year end has been April, 31st April. But in 2003, the year did not end in April.
So what is the year of change? What year are we going to say they change in the first scenario and in the second scenario?
The first scenario, the year of change will be 2003. And the second scenario, the year of change will also be 2003.
Who else? Who else? Who is helping us? Who else?
Sorry, let me go. At least the basis period, the year end, at least it will show in the year accounting year in 2004. That's the first scenario.
Second scenario.
The second scenario, if this is ended to 12. So, yeah. Sorry, let me calculate this.
Okay, while we wait for Mr. Ozeni, who else can help us out?
Okay, the first scenario the year end will be 2003,
No,
but the second,
the
but the
year of
second
change. The year of
year,
change. The year of change.
okay, the year of change is 2003 for the first scenario, but for the second scenario is 2002.
Okay. The year of change.
Yeah, year of change is 2003 first scenario, second scenario 2003. Because we can see the period 2 is telling us that it's no longer those 12 months. There has been a change in the accounting period.
Thank you, Kay. You see,
That's the pointer.
that's the point.
That's the pointer is period 2.
The
I think when we
period
see-
is pointer.
Yes, that is what you're pointing us to, year of change, period 2.
Thank you, Olusoji. You're ready. Okay, you guys have tried, but you did not get it right. To identify the year of change, this material has been with you for some days, or you have not been reading it. To identify the year of change, the difference between the old accounting date and the new accounting date must not be less than 12 months. It must be greater than 12 months at every point in time. So when you look the new old accounting date, which is 31/12/2002, and the new accounting date, which is 31/3/2003, how many months is that? So before you say a company had changed, we must see a full set of accounts. But in this regard, it's not up to 12 months. So we say in scenario 1, this company had not changed in 2003. Rather, the year of change will be 2004. You move it to the next one, 2004. Going by that, my principle, who can tell me the year of change now that you know the principle?
2004, 2005, 4, yes. That's we'll have to pick from the next year. So 2004, that is the year of change.
Okay. Who else?
I think from that principle,
2003.
the year of change in 2 will not be 2003.
The year of change will be 2003 from the principle.
Yes, sir. Yes, sir.
Ibukun, is that the same school of thought?
Yeah, 2003, because it's greater than 12 months.
Good. So, and that's why you have to look at it very well. This is in the exam. Examiner will write 4 months to, in this one now is 14 months to, oh yeah, you get. So this is 14 months in difference. So it's more than 12 months. So the company had changed in 2003. In the first one, the company changed in 2004. Do you understand?
Thank you so much, sir.
Yes. So that is the principle. So let's go. Now, having understood the principle, what are the reasons why company might decide to change their accounting dates? Number 1, to obey government directives. I'll give you an example again. In 2005, there was bank recapitalization. How many of you remember that? Mr. Wellington, you remember, and Mr. Zain should remember.
I
don't
remember.
know.
Yes, sir.
Yes.
I remember very well.
So
Against
before that time, okay, Mr. Cyril, you should remember.
Well, vividly.
Before that time, you will remember that banks, a lot of them usually prepare their account to earn different dates. First Bank will come and say 31st December is my own date. Union Bank will say 30th September. The other one will come and say it's April. My own is April. Another one will come and say my own is 31st March.
Some June.
Some June. CBN was looking at them. When CBN did audits, CBN noticed that some of them, when they are doing their year-end closure, they will go and borrow money from another bank to have their liquidity, cash to liquidity ratio, I forgot, cash adequacy ratio to be okay. You know, when central bank gets there to audit them, they will say, they are okay. Even on the stock markets, they will value them very well because we believe they have money. Okay? After the audit, they've closed the year. They will return the money back to the bank they took it from. That was the usual practice. So when central bank central bank noticed that, what they did was to say, okay, now everybody prepare your accounts to 31st December. That's number one. Number two, we are recapitalizing banking industry. Your capital base now should be 25 billion. And that was when a lot of people would not make up, a lot of banks would not meet up with that 25 billion, and they were run aground. A lot of them merged, a lot of them shut down. They gave them deadline. So we are saying to obey government directives here means government has directed you, prepare your account to end these dates. You don't have any choice. The next one is to execute new tax policy. Finance Act came up. And the way we have been doing our commencement rule change is because of the new tax policy. And we are still expecting another policy this year. Hopefully, they will allow it go through. But for now, even if they sign it tomorrow, it's not going to affect this year exam. Okay? So, and it might not even affect November diet exam. So be rest assured that you are still going to be operating on the one we have. So what I am saying here is that new tax policies are another thing that can also make a company to change the accounting dates. You remember, before you can consolidate financial statements, to make consolidation easy, one of the things that you need to do is to ensure that the holding company and the subsidiary operates the same accounting year end, without which the company will not be able to consolidate. So for ease of consolidation, that was one of the reasons for change of accounting dates. The next one, merger and acquisition. We've talked about that. When two companies merged and they lose their identity, so they need to change their dates. They might want to change or leave it. Or imagine two companies are merging. And for them to be able to consolidate, they must have the same dates, right? So we're not saying these two companies that are merging, they must have the same accounting date, but one is using different accounting dates from the other. So the two of them might decide to leave the accounting date and choose one, or one will say, okay, let you choose my own accounting date. So that's one that is choosing another person's accounting dates would have to be, we have to apply the change of accounting day rule, okay? And that is that. Acquisition too will be one of the reasons why you do that. Now, having said that, we now look at what are the tax authorities' consideration when a company is changing its accounting dates. Number one, we want to look at the objective of the change. What is the objective? Is the objective to evade tax? If the objective is to evade tax, such will not be granted. Number two, we want to ensure that The years involved does not include year of permanency. That is, the years involved does not include year of cessation. If it does, then we are not going to grant the year of change. You want to cease and you still want to change accounting dates. It doesn't work that way. So you have to choose one. Whether it's either you change your accounting dates or you cease operation. So, but you cannot do the two at the same time. So change of accounting dates. You either choose whether you want to change or you want to cease. The next one is the taxpayer must also request for this change. Request. You must send a request to the tax authority in writing that you want to change. What are the procedures for computing change of accounting dates? Number one, you must determine the year of change, the first year of change, the first year in which the company failed to prepare the account of the known dates. In this regard, you remember we have said we calculated the year of change the other time. I showed you how to determine the year of change, the first year they change. Number two is that you must determine the 2 years after the year of change. So in this regard, let us assume the first year of change here is 2020. You will now determine 2 years after the year of change, 2022, 2021, and 2022. These 3 years that you have identified, that is 2022, 2020, 2021, and 2022. You will assess them on preceding year basis using the old accounting dates. Again, these 3 years I have identified also, you will assess them on preceding year basis using the new accounting dates. After, you will get an answer for this. And you get an answer for these 3 periods. You will add this together. You will add this together. If the new accounting date is higher than the old accounting date, you will recommend to the tax authority to assess the taxpayer on the new accounting date. If the old accounting date is more than the new accounting date, you will advise the tax authority, you will recommend rather to the tax authority to assess the taxpayer on the old accounting date. Doing so will lead to the maximization of revenue of the tax authority. That is that. So, having understood the process, the steps, we can now go ahead and compute. Let's look at an illustration. So let's go to the next illustration. Standard trust. Who is helping us to read? Who is helping us read? I'm waiting. Yeah, KP, read for us. K, read for us. Catherine.
Okay.
Yeah.
Um, okay. Standard Trust Bank PLC, a leading financial institution in Nigeria, decided to change its accounting date due to the government policy that stipulates that all banks must have uniform accounting dates. The following result was taken from the books of the company. Adjusted profit for year ended 31st March 2024, 800. Adjusted profit for year ended 31st March 2025, 900,000 naira. For year adjusted profit for year ended 31st March 2026, 1 million. Adjusted profit for period to 31st December 2027, 1.7 million. Adjusted profit for year ended 31st December 2028, 700,000.
Required to compose the assessable profit for the year and give appropriate recommendation. Now, Mr. Wellington, what's the year of change in this question? What's the year of change?
In this scenario, the year of change is 2027 because from the last year end of 31st March 2026 to 31st December 2027 is more than 12 months. Therefore, the year of change is 2027.
Good. Thank you, Mr. Wellington. You are following. So the year of change is 2027. Now, you remember we said during our steps, we said you will identify the year of change and 2 subsequent years after the year of change. Have you? So if the year of change is 2027, 2 years after the year of change will be what? 2008 and 2029, right? Abi? 2027,
Yes, sir.
2028, and 2029.
Yes.
Who is not following?
We are following.
You are not following?
We are following.
Okay. So, if that is the case, we now know that the year of change in this question is 2007 times 27. Two years after 2027 will be 2028, 2029. Okay. For those of you that you still do not have this book, I am the author. If you are interested, you can request for it. Okay. And if you would prefer soft copy of the book is available, which is 8,000 for 6-month access. After 6 months, the access will be gone. The hard copy is 16,000, and that is for live access. Okay. I just need to bring that to your notice. Okay, let's go ahead.
Sorry, sir. Second edition, is it valid? Is it still valid?
No, I have 4th edition. I have 4th edition. I'm just using it so that it's the same color.
Okay.
4th edition. I have 4th edition. So, as I was saying, it is very important to know the year of change. I know the 2 subsequent year of change. Now, these years that you have identified, you will assess it to tax on old accounting dates. Who can tell me the old accounting date of this company?
31st of March.
Good. That's the old accounting dates. Assess those tax on preceding year bills. This will be 1, 4, 2022, sorry, 25 to 30th 3 2026. Abi, the next one will be 1/4/2026 to 31st 3 2027. Next one, 1/4/2027 to 31st of 3 2028. That is the old accounting date, right? The same thing that you did for old accounting date, you will do for new accounting dates. New accounting dates, which is 31st March, 31st December. So it will be 1/1/2026 to 31st 12 2026. 1/1/2027 to 31st 12 2027. 1/1/2028 to 31st 12 2028. So you can see that we have done, you will do for old accounting dates, you will do for new accounting dates. The next thing for you to do now is to ascertain the profits for these periods. So let's go. Look at this guy. I need 1/4/2025 to 31st March 2026. I'll come back to this my table. In this my table, this is 1/4/23. This is 1/4/24. This is 1/4/25. Abby, and this is 1/4/26. Let's go. How many months is this? 12. How many months is this? 12. How many months is this? 12. How many months is this? It's more than 12. Who can help us out? How many
21.
months? 21 months.
21.
21 months. Now that we know that it's 21 months, we can now go ahead. Let's first do the old accounting dates. Look at these dates in 2027 and these dates. You notice that they look alike, Abi? No calculation is required. That first one is 1 million. 2027, old accounting dates. 1 million. The new accounting, sorry, this 2028 now. In 2028, I need 1/4/2026 to 31st March 2027. Have you? This is 12 months. Don't forget. It's also part of it. So, but when you look at this, you will notice that this 1/4/2026 to 31st March 2027 is within this period. Have you? And the total number of months in this period is 21. But me, I need 12 months. So I will say 12 over 21 multiply by 1.7. What do you have? What do you have?
Nine seven one to 9, approximately.
9.
7-1.
429.
The next one, 2009. You know what I need? I need 1/4/2027 to 31st March 2028. Where can I get it? I can get 1/4/2027 to 31st 12 2027 in this one. Abby? And this is 9/21 multiplied by 1/7. I am not done. Hold on, guys.
Now, egg you carry. How many credits? How many?
Put your phone in silence. Mute yourself. Good. So that is 9/21 multiplied by 1/7. So you get your answer. What is the answer? What did you get?
728571.
728,571. We are not done. We still need we need from 1/1/2028 to 31st March 2028. Where can you see that one? You can see that one in this one because this one has started from 1/1/2028. Abi? So that is 3 months, Abi? So we have 3/21 multiplied by 700. What do you have?
So
Whatever you
it's 3
have.
over 12, not 21.
Sorry, over 12. I wanted to write 12. I am testing you. I wanted to be sure that you are following me.
Stop, Dad. Don't you know what that means? You're still going to use that thing. I have one you can use. Let's take this. Drop it.
Sorry, guys. So, divide by 12. Divide by 12, multiply by 700. What do you have?
175,000.
If you add 175,000 plus this, what will you have? What will you have?
903,571.
What did you call it?
903,571.
If you add the three together, what do you have?
1,903,571.
It's more than that. 1 million plus 971 plus 903.
Okay. Sorry. 2,875,000.
Yes, that is for the old accounting dates, right? Now, we need to calculate for new accounting dates too. I'm going to clear the board. For the new accounting dates, you remember we said I need 1/1/2007 to 31st of 2027. No, 2026 first. Where can I see this on my table? I can see from these two, Abby. So I can see 1/1/2026 to 31st March 2026. That will be 3/12 multiplied by 1 million. Abby,
Yes, sir.
that will be what, 250, right?
50,000, yes.
Now I also need from 1/4/2026 to 31/12/2026. Where can I see this? I can see it in this one. You remember, I told you this one started from the minute after the end of this one. Abi? And the entire month we have here is 21 months. So we need 9. So I'll say 9/21 multiplied by 17. What do you have?
728,571.
728 571. Add it plus 250.
978,571.
978,571. The second one, we need from 1/1/2027 to 31/12/2027. Where can I get that? I can get that here, Abby. So, which is going to be how many months we need? We need 12 over 21 multiplied by 17. What do you have? 903 something.
971.
Okay.
429.
971
71.
429.
429.
The last one is from 1 2028 to 31st 12 2028.
It's direct.
That
700.
one is given 700. No calculation is required. Add the three together. What do you have?
2,650,000.
So you can now see that the old accounting dates gives a higher return, right? So the tax authority will assess the taxpayer on the old accounting date. Let's go and see the solution. You can see. So the tax authority will assess the taxpayer on the what? On the old accounting dates as against the new accounting dates. Okay? So that is that. The solution is here in case you still want to look at it and see what we did. Okay? So that is the end of today's class. Do you have any question for me?
So, sir, as regard the recommendation, is it just to state that the accounting will be assessed on the old accounting date instead of the new?
Look at based on our own computation, the tax authority should assess the taxpayer on the old account and they state the figure as against this. This is because assessing the taxpayer on the existing accounting dates will lead to the maximization of revenue of the tax authority. Stop. Do you get?
Thank you.
So that is that. We see again by next week. I'll send the material that we're going to use to you, even though we had a plan to send everything at once.